What is going on, guys? Nick here, back with another video. A few months ago, I took a look at Alibaba stock and I was shocked at just how cheap the stock was. I was so surprised that after taking that look, I ended up buying a leap on them, especially after Charlie Munger had announced a position. And right after I bought the stock, the leap ended up rising all the way from about $4,000 to about $5,500. I thought it was a great deal. But in December, the stock market and Alibaba both became pretty volatile, and Alibaba stock ended up falling all the way back down to 110. But there's been a lot of discussion about the company lately, with Charlie Munger doubling his position and the stock price still continuing to fall. So in this video, I'll show you guys what I found after taking a deep look into the company, and ultimately why I changed my mind on Alibaba stock. To understand Alibaba and all the issues that they're facing right now, we first have to understand what's going on with the Chinese economy. The Chinese economy is facing some pretty serious challenges right now. The Chinese people don't keep their retirement savings in the stock market like we do in the US. Instead, retirement money has been put into real estate, which has been a mostly safe investment for them. But the problem is, all of this real estate investment has driven up demand for new construction, which has pushed the housing supply so out of control that entire cities have been built with no actual demand materializing, resulting in massive city ghost towns with no actual residents. Right now, nearly 3/4 of all household wealth in China is in housing. And unsold housing in China's 100 biggest cities rose to its highest level in 5 years in November 2021. And on top of this, and probably pretty unsurprising at this point, demand for housing is starting to show signs of slowing in China. You might have heard about the Evergrande debt crisis. To catch up really quickly, Evergrande is one of China's biggest real estate developers, but the company is facing some very serious debt issues. They have more than $300 billion in outstanding financial obligations, hundreds of thousands of unfinished residential buildings, and angry suppliers who have shut down construction sites over missed payments. The company has gotten so desperate to cover its debt that it started to pay bills with unfinished properties and have asked employees to lend the company money. 3.8 million jobs and hundreds of thousands of employees will be impacted if Evergrande collapses. And the damage won't just be limited to them. If the real estate bubble pops, the individual citizens of China stand to lose a lot of their wealth. The Chinese government, though, is committed to protecting China from the economic crisis. However, what you have to remember is this is not a capitalist system. While they've definitely allowed some aspects of capitalism to exist in their country, they are still a communist state with tight economic control. President Xi says the Communist Party will pursue common prosperity, which is going to require businesses and entrepreneurs to help cut the wealth gap in China. In September, Alibaba, who's been under the microscope of the Chinese government, which I'll get into in just a minute, announced that they would invest $15.5 billion for the common prosperity goal. The money is supposed to provide insurance protection for gig economy workers like delivery and ride-hailing drivers. But in October of 2020, Alibaba's founder, Jack Ma, spoke at a Shanghai conference. During his speech, he criticized the Chinese financial system, saying that good innovation is not afraid of regulation, but fear of outdated regulations. Ma went on to criticize the banking system, saying that their way was outdated, and this criticism came in front of senior Chinese government officials who were present at the conference. President Xi, who was not at the conference, heard about them and was absolutely furious. Xi directed Ma's business group to be punished. First, Ma's Ant Group was forced to withdraw from its stock IPO, and these new rules included being reclassified as a financial holding company overseen by China's central bank. These rules are expected to cut Ant's growth and profitability. And at the same time, the Chinese government launched an antitrust probe into Alibaba, which was completed in April 2021 and resulted in Alibaba being fined $2.8 billion. But the crackdown on big tech hasn't stopped with this antitrust probe. The government has been forcing Alibaba to sell off some of its investments, including its media assets. Beijing is focused on reducing the potential influence of big tech on public opinion, which is why Alibaba's investment in the largest English-speaking newspaper in Hong Kong would have to go. They've also been forced to sell their stake in Weibo, a state-owned media company similar to Twitter. And the regulations have continued. The Chinese government is considering blocking foreign IPOs if the authorities deem them threats to national security. And they may be required to divest assets to eliminate or avoid the impact of overseas investment regulations on national security. Which leads me to another big concern, which is delisting. The US government is planning to enforce regulations on Chinese companies who list themselves on US stock exchanges by forcing them to submit their financial audits for review. Many Chinese stocks will be impacted by this enforcement if some sort of deal isn't reached, since the Chinese government refuses to allow financial audits on the basis of national security. And with this recent recent regulation potentially blocking foreign IPOs, it seems like China isn't going to budge here. Now, this would mean that the Alibaba shares could get moved to the over-the-counter market, where stocks really don't get supervision and often has less access to individual investors than stocks listed on the big US exchanges. This potentially could mean that the stock will see a lower share price, as stocks traded on the OTC market tend to have less liquidity. So my concern with Alibaba is, as the Chinese economy struggles to find growth and deals with a massive devaluation in housing supply and individual wealth, it seems like the Chinese government's solution to fix the problem is to force the big business in China to support the people through common prosperity. And the more that I think about it, the harder it is for me to see the Chinese government allowing Alibaba to continue to grow like it has in the past. If their goal is to reduce the wealth gap, I don't see how they allow Alibaba to continue to gain more and more profits every single year. It also seems like President Xi wants to cut the power that a lot of these big tech companies hold in China, and I don't really see why they would spare Alibaba's profits with that goal. It may be very true that Alibaba is very cheap compared to its trailing valuation, but that's only if you use conventional valuation measures and don't adjust for the risk fully. And the risk in this case, to me, seems like a total wild card. How far is the Chinese government willing to go to reduce Alibaba's power? And how far is the Chinese government going to allow Alibaba's profits to continue to grow in the future? And for me, this is why I'm out on Alibaba. It seems like the Chinese government might be going through a time where they're not going to allow these big tech companies in China to just continue to grow and gain power and influence. Especially big tech companies whose founders they're very, very angry at. Now, I know Charlie Munger believes in them, and right now it's his third largest holding in his portfolio. However, his second largest position is Wells Fargo, and I don't think that anybody is about to open up a huge position in Wells Fargo just because Charlie Munger owns a whole bunch. Charlie Munger is 98. I'm 31. We have completely different time horizons, and I cannot invest the same way that he will. So I know I didn't include a stock analysis on this video like I usually do, and that's really just because I don't want it to distract from the rest of the video, which I think is far more important of a message. Make sure you guys check out this great video I have for you next, and as always, thanks for watching.